Okay, so we're back. Abram Caballero here from South Texas, the very tip at the bottom of Texas, Brownsville, Texas to be specific, the best place to find tacos. Anyway, okay, so let's get right into it. This is video number 2, and here we are talking about the types of whole life insurance. Okay, and I'm gonna do my best to try and break it down for you. Every single video, it's gonna be something different, as in the type of insurance, the interest crediting strategies, and again, this is for you. Okay, this is who I'm doing it for. So let me know if it helps you, if it confuses you. I want to make it easier for you. Okay. So understanding the types of whole life insurance. Whole life insurance, as we discussed in the previous video, this is a permanent policy that does not expire. So if it doesn't expire, these are the options that they give you for it. How to have a permanent policy that's going to be forever. It's not going to expire, but what can be cut off, can be limited, is your payments. That's the only thing that can change, because a whole life is a whole life. It's going to be for the rest of your life. But the thing that can change is your payments, how you're making the payments towards it to pay it off and make it yours. Now, think about it like this. Let me give you an example. If you finance a car, let's say that it's a $50,000 car. You finance the car. Let's say that your payments are $700. If you do it over 72 months, I believe it would be the largest option, or 60 months. But if you finance a vehicle and it's going to be $700 over that many months, and that's going to be your lowest monthly payment, it's because of the length of how long you're going to be paying it. Now, if you finance that same car for 3 years, so let's say it's 36 months, the payment is no longer going to be $700. Now it's going to be, let's say that it's going to be $1,000 a month. Okay. But you're paying $300 more for many months less. So for a shorter period, you're going to be out of that car loan, that car note. And you're actually going to, even though it seems like you're paying a little bit more monthly, but if you do the math, add all those months up, and even though you're paying more during those $300 more during those 36 months, you're actually ending up paying less. If I hope that makes sense for you, I hope it makes sense for you. I'm trying to break it down, give you some simple options to understand. So here's the thing. Because you have the option to pay a whole life, like I wouldn't want my parents to be paying when they're like 80, 90 years of age. That's typically how I've seen whole life policy structured. Because if you have somebody that's paying for the rest of their lifetime, they're going to be paying up to like age 100. And then what happens when you get to age 100? Right. What happens when you get to age 100? It is known as now they like you stop the payments, and they actually give you the money back. Like they give you the option of just giving you all of the cash value that's accumulated. And we're going to talk about how the cash value grows in other videos. But here we just need you to understand the types of policies that there is. Now, how I mentioned that if you get to age 100, they give you your money here. It's not your premiums. It's not what you've paid in total. It's a cash value plus interest that should reach maturity, which means at age 100, your cash value must equal your death benefit. So if you have $50,000 of death benefit, that's what your cash value should be. If you have $100,000 of death benefit, that's what your cash value should be. If you have $1 million of death benefit, that's what your cash value should be. That's maturity. And what happens when you reach the maturity is an endowment. They give you the option just to cash it out. It's known as self-insured, because what you bought for insurance, it has now been paid off, and you have now matched with your cash value what you had as a death benefit. Hope it made sense. Now, so there's something that's called a paid up policy, and I have this on my TikTok. So I have it on my TikTok. It looked like a call was coming in. Sorry about that. Where I'm explaining that how the paid up policies, and I give you several different options so that way you can compare. So you can go and look it up. I can put the link in the description as well. Paid up just means that you're going to pay it off. You know how I mentioned the car, if you can pay it off in 36 months and you're out of that car bill a lot faster? Well, that's a paid up policy. You're paying your life insurance, your whole life. You're paying it in 10 years, in 20 years, in 30 years. And it's done and paid for. Never do you have to worry about another payment again. That's paid up life insurance, paid up whole life. The other one is a modified whole life. And the way that you illustrate a modified whole life is like this. If your payment is in the first 5 years, it's going to be level, and you have it at, let's say, $75 a month. On the fifth, sixth year, it goes up. And let's say that it now, for the rest of the lifetime, it's going to be at $125 per month. It's a simple example. But you see here, in the first 5 years, it stays level, lower. It goes up once, and then it stays level. So the way that I describe it is this: level, up, level. That's how, it's the easiest way to put it. Now, single premium, as it says here, single premium just means that you make one single payment. That means that if you have $30,000, $50,000, you just drop it into the insurance company. Instantly, when you're approved, you are now insured for, as an example, if you give them $30,000, depending on your age, but more than likely, they would possibly offer you $60,000 if you paid $30,000. So it's like doubling the money that you gave them. Single premium just means that you make one single payment and your policy is paid off for the rest of your lifetime, or the insured's lifetime. So it would look like this: single premium, whole life, paid up. And paid up, there's also another word to it, but it's typically paid up whole life. And it would be like paid up 20 whole life, paid up 10 whole life, paid up 30 whole life, and so on. Now, the last option that we have here is graded whole life policy. Again, graded whole life, WL. And it's going to look like this. Every year for the first 5 years, it's going to go up in price. So think about it as an elementary. Grade 1, grade 2, grade 3, grade 4, grade 5. In the first 5 years, it goes like this. It's like stairs. Grade 1, grade 2, grade 3, grade 4, grade 5, level thereafter. So here, let's say that you're starting off with $40 a month, $50 a month in year number 2, $60 a month in year number 3, $70 a month in year number 4, and $80 a month year number 5, and so on. This is what graded means. It goes up first 5 years, 6 years, and then it stays level, flat after that. Okay. So I hope this helps you in understanding the types of whole life policies. Next, we're going to be covering universal term policies, and then other policies as well. I'll see you on the next one. Bye-bye.